afternoon, everybody. Welcome back to Schwab Coaching for our next topic, getting started with stock investing. Little more specifically, perhaps when to buy is what we'll be covering here for you all today. I'm your host, Kevin Horner. Thank you all for being here with me this afternoon. The day has kind of devolved into a bit more of a selling day in the broad market. We're going to utilize the opportunity here for movement in the market to talk about trend analysis in a greater detail with you all today. So we're going to work through a couple of specific slides highlighting some traditional concepts of technical analysis, some entry-level concepts for those of you getting your feet wet in understanding the market here. And then we're going to look at ways to involve the current market situation and find opportunities in the market that are relative and appropriate given the current market environment. That's a big process here for a lot of traders. It's a hard process to really get familiar and comfortable with. It does take a fair bit of time. So my hope is that by the conclusion of today, you'll be maybe provided with a few example ideas that you can utilize in your day-to-day work, the time you spend in the day to look at the overall market and try to get a picture of maybe where leadership is, where the laggers are, and where you wish to invest versus where you might wish to avoid investing from time to time. And I'll give you a few tools within our Thinkorswim desktop application today that can be used on a day-to-day basis to help you all with that. So before we kick off, please say hi to my friend there in the chat. It's Mike Fairborn here today. Follow us on X. Mike is Mike Fairborn CS, and I am Kevin Horner CS there on X, formerly Twitter. We'd love to have your follow there. We try to post for you throughout the week, if not daily, with a number of key charts that maybe we're monitoring or keeping our own eyes on. So you are encouraged, invited, and we would love to have your follow there on X. And if you like today's content, please also remember to hit that thumbs up button for me down below. We will be archiving this segment, of course, and I want to make sure that it gets out there for as many additional potential viewers as possible. So let's hit up our disclosure detail before we move into the conversation today. Remember that the discussion is exclusively informational and educational. We do not make recommendations here. We do not endorse a particular or specific approach to trading either. We do talk technical analysis. In fact, today's topic will be heavy on technical analysis in terms of concepts, strategies, terminology. The reminder we give with regard to technical analysis is that it's just one piece of the overall puzzle. We think it can be helpful in determining your entrance or exit on individual positions in the marketplace, but we do not encourage you to base those decisions exclusively off of the technical viewpoint. So please keep that in mind. The extent to which we cover the conversation around stop orders, a process a trader might use for exiting trade-specific opportunities. These stop orders do not guarantee any price. They typically trigger and become a market order to sell, which means you'll take the next available market price. Commonly, that can be away from your trigger, though, so we want to be aware of that as well. And if we get into that, I'll provide more context so you have a better understanding. Feel free to post your questions on any of these topics that we covered today in the chat, and I'll try to answer as many as possible. So when we start talking about the so-called when to be a buyer, it's commonly thought of as the instance when we know we have a well-developed uptrend. There's no reason in the market to invest your dollars if you're a trader per se, right? Looking for trade opportunities, the idea of finding value at a certain price and because you think you can sell that at a higher price later on. That really is a trader's mentality that differs quite a bit from the investor's mentality, which might just simply be accumulate, 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 and spread out those investment dollars amongst asset classes, amongst sectors, and amongst industry groups. That's a common way for traders, investors, I should say, excuse me, to invest, but to reduce their risk is to deploy money over the landscape of the market. If you're trading, though, commonly that trader will look to move out of trades that are no longer working. So admitting, hey, what was working before is no longer. And as you can see on this particular pattern, we have a moving from the lower left to the upper right series of price action, which means we have an uptrend. Higher highs along the way, higher lows along the way. We also have a moving average line drawn through the price action. In this case, it's a 30-day simple moving average. That is calculated by looking at the prior 30 calendar days, or prior 30 trading sessions, taking the close, adding them all together, and then dividing it by 30 to give you the represented line there, the average price on any given day. And that line smooths out that price action. It's, in many cases, in the midst of a trend, it can be the so-called medium or the mean location for prices to manage themselves, to work against as support, to work against as potential resistance. In this case, what we've seen is that instances where price action fell to or below the 30-day moving average, those have been instances where traders have been afforded the chance to add positions or join the uptrend for subsequent participation. So they would have been able to maybe start here, and then as you get above the moving average, consider adding, and then here, sticking with what you got until you get to this point again, and you see this kind of a move, and you say, well, now we're below it again. Are we recapturing it quickly, getting back above it? Some traders would add there. But the point is, we can utilize technical analysis in a fairly generic manner to help us know, should we be looking at an S&P 500 investment at this moment in time, or should we maybe be sitting on our hands? Or if you want to get more granular, maybe we look at the various sectors of the market that look or resemble the chart action of something like the broad index, the S&P 500, and then see which ones mirror that move versus which ones look a lot different. So there will be leadership from groups in the market that are not going down today, even though the broad market, generally speaking, is having a bit of a rough day. So that's what we want to kind of cover here today. So this is your standard basic trend. Uptrend would imply that if you looked at this and said, well, I want to have an uptrend, what you're working with here on this chart would be the kind of chart that would bring your eyes to it and say, yeah, this is a group, a position, something I might consider for an investment. Now, as we move forward, we should also be considerate of not just moving averages, but standard support or resistance. So what are support and resistance? If this is the first time you've heard these terms, let's just level set. Support is often referred to as the price floor. Resistance is often referred to as the price ceiling. Now, the good thing about support and resistance, floors and ceilings as it relates to price action is they can be violated to the downside. If you fall through support, that's a bearish indication. If you move price action through a banner or a line of resistance, that's considered to be a potential breakout, of course. And one of the main concepts as it relates to support and resistance is that when support gets broken and we have price action going lower, what was support now becomes new resistance. Just think of it like being in your standard multi-layered building, right? A 10-story building, you're sitting on the 5th floor, and if you fell through the floor on the 5th level, you'd be residing suddenly on the 4th level. And your 5th level floor is now your ceiling in the 4th floor, right? So that's all we're talking about with standard support and resistance. And the truth is, while you can find many a security, many an opportunity in the marketplace with trend analysis, you will often see that stocks that are showing trends, higher highs and higher lows, a nice clear pattern, when those patterns shift, they often have to find support in what we would call the horizontal level as opposed to a trend situation. In fact, we could maybe look at the S&P right now and highlight how this could play out. Take a look at where we reside or where maybe we don't, where we're in danger of trading lower. If I were to zoom in here, we've had, see how the blue or the purple 50-day, in fact, let me clean this up for us a little bit. I'm just going to change my study set so it only has the 50 and 200-day moving averages on it. There we go. So now, if you just make note, there's your 50-day moving average, nice upsloping, right? And that was support along the way until it wasn't. And basically everything that's happened since right around here, and I should probably go a little higher. I could probably do it more like this. All of this price action is showing us that we've really gone sideways, right? Because if we'd not just gone sideways, well, then our prices wouldn't be all over the place relative to the moving average, relative to the 50-day simple moving average here. In this case, what we're getting is a slowing of our pattern, slowing of our trend. And if we were simply looking at it from that standpoint of, are we finding support? Well, we are in a potential support spot, right? Support being a level that we've traded to previously and we've then bounced. And so what are we pointing to? Look, just 2 days ago, we were right at that level and we bounced off of it. Now we were at this as was a gap level that happened back on January 15 from the January 14 day. So we had a gap up, and we'd had, prior to right now, had been above it for the entirety of that window. That's almost 6 full weeks, everybody. And now we're getting a bit of a breakdown. So here, falling through a potential area of support, this becomes a delicate spot. Now, the hard part right now is that we're in the midst of a market move. There's 50 minutes remaining in the market day. We see general weakness. It's not just the S&P 500, as you can see. We've got the NASDAQ down 2%, the Russell down, the semiconductors really down 4% there. But you'll notice if we go down into the sectors, everybody, we've got groups that are up today. Energy is up, although the chart won't look fantastic. There's not a whole lot of a trend here. But what I want to remind you is the market will provide opportunities. You may not expect them. You might not be prepared for them. You may not have seen them before. But there is a common axiom amongst investors and traders alike. That is that there's a bull market somewhere all the time. The question becomes where? And can we as investors and traders put ourselves in a position to capitalize when we see those dynamics changing and shifting a little bit? So let's look at one that is providing a little bit of leadership relative to the overall market. And I can do that on the chart and point out that we had the staples sector move to new all-time highs just this week. But I think it might be easier for many of us to monitor via the Market Watch tab and the Quotes tab. So here I can go in and select from our public lists the Standard & Poor's, the S&P sector indices. Okay, so that's just these 11 sectors themselves. And what I've done here, everybody, is I've put up a 21-day relative strength, which lets you know what is the relative leader of this group. Right now, if I put it by sort, you can see that our relative strength outperformer is the Staples Group, followed by real estate, followed by utilities, followed by healthcare, and then financials right there. Now, we can also play with some of these columns that would be maybe helpful. One of those might be, so I have the 52-week high, the 52-week low, but I think a little more proper might instead be the percentage from the 52-week high or the 52-week low. So let me see if I can bring this in here. Let's do it with 52. There it is. Percent change, 52-week high, percent change, 52-week low. And so now I can clearly see by a pretty a calculation, at least, that's going to make a little bit more sense to me, how close are these groups to their 52-week high or 52-week low. Look at the discretionary. This is one of the ones I wanted to call out today. Discretionary is 13% down from its 52-week high. Now that is a pretty good move in terms of a sell-off in a broad sector. So let's look at discretionary briefly here. I'll put that into my details. So we've had an S&P 500 move that has broken the trend of higher highs and higher lows. We're hopeful that the S&P 500 is finding support at its current lows today. But then we look at a sector that is doing worse than even the S&P 500. It's discretionary. Now, I'm sure there are many out there saying, well, I have a pretty good feeling why maybe discretionary is struggling. You might be thinking of a couple of stocks in particular that are in discretionary that have been struggling, and they could be leading that group to the downside. And that's entirely fair to suggest. Tesla's the name that comes to mind when we think about that. Now, that doesn't mean that it invalidates what you're seeing on a chart here, right? So we have suddenly a broad market position of somewhat weakness in the short term, longer term weakness as it relates to consumer discretionary. We've got defensive groups leading, like healthcare, like utilities, like real estate, and consumer staples. Okay. Now, real briefly, why do we call those companies defensives, or why are they considered to be defensive? Well, I tend to think of it more along the lines of what is how they differ so greatly from what our standard leadership is. What do you guys all like to see leading the market? When you individually, when you all are excited about the market's moves, market's making higher highs, higher lows, you've got good volatility to the upside, you're excited, you wait on these earnings reports from big name companies, and you are thrilled. What is the group that provides leadership then? Likelihood is technology, right? And one thing we know about technology is that we have a group that is focused on growth, not necessarily focused on things like, do they pay a good dividend? Is their valuation per share appropriate and adequate? Does it make sense? No. Because when you have high-flying companies moving from 40 to 100 in the course of 6 weeks, well, then those are companies that are not going to give you fundamental valuation, right? Those are not companies that are going to reflect a healthy balance sheet per se, okay? At least not as it relates to some of the stuff that we've talked about previously in this particular series, where we delve into things like price to earnings ratios, price to book ratios, price to sales ratios, right? If your market is being led by tech, well, then valuations tend to get tossed out the window. They don't care about that. The market tends to care about, the traders of the market tend to care about the trends. We worry less about valuation. And of course, when things start to shift, as we might be seeing at this moment, is we want to lean into some safety, some stability. So investors pull back on those riskier assets and look for stability in the form of value, right? Lower PE ratios, maybe a dividend paying security or two, something that's going to provide a more clear level of return with a potential upside opportunity thereafter in the form of price appreciation. But, when I think about the view here of discretionary kind of rolling over, maybe continuing to struggle for the coming days and weeks, we want to look at the groups that might be opportunity if you believe that you want to be a buyer in the market, right? And if we looked at where, like I said, that staples, how different this looks, it is so obvious from the chart standpoint, new highs in staples, new short-term lows in discretionary, those go opposite, right? So if you were a trader who is looking for still bullish chances in the market, bullish opportunities within the market, you might avoid discretionary today, right? You might have some chances, don't get me wrong. A trader out there could certainly find a stock or two in a struggling space. But think about this, everybody. If you are looking at discretionary and you're saying, man, I would really love to own that ABC stock because for one reason or another, doesn't matter. But the thought is it's in a basket of other stocks, right? And you know what? That basket only has 2, 3, 4 good looking opportunities. Why not lean into something with more good looking opportunities? I liken it to the car dealership, for example. You got a car dealer who's got a massive lot of vehicles, and they've got them scattered all over the lot, and storm moves through, hits a portion of that lot, but not the other portion, right? So you've got half of them of the parking lot at this dealership got hammered with hail. The other half did not. Where do you want to go looking for your opportunity to purchase a new vehicle? You probably want to avoid the side of the market, or the lot as it were, that got beaten up by hail. You want to look at the side that's been doing well all along. That's kind of that thought process, okay? So when we think about the broad market like the S&P 500, or even something a little bit more definitive like the NASDAQ 100, which is very tech heavy, we can still look for those opportunities by saying, I want to be a buyer, but if I'm going to be a buyer, I just want to be a buyer in the groups that are outperforming on a relative basis. On a day like today, when the market is red collectively, who do I want to lean into? The leaders on those days. Now, this takes an approach or a viewpoint that what we are witnessing today leads to further weakness. Now, I can't tell you that that's what's going to happen, obviously, but what we want to understand is this relationship between these groups, right? So, monitoring that on the Market Watch tab. One way you might do this, everybody, just think about it like this. Just go ahead and detach one, put it on the side here. And remember, you can detach as many of these as you want. I'm going to pin this so that it stays right here. I'll detach another one, bring that over. And so just as a reminder of the freedom that this tool gives us, put this one side by side. And so I've got the sectors over here, and then I'm going to change this one to sectors and industries. And now everything that I've got is not just the 11 sectors, but also the industry groups within those 11 sectors. And if I want to see leadership again, show me the ones that are the closest to their 52-week high. So we'll sort by that, right? So here you go. Your ones that are basically at 52-week levels, okay? Healthcare, REITs, automotive, and REITs. So oddly enough, S&P 500, automotive retail, that's intriguing, right? That might stand out a little bit as I just got done talking down Tesla, unfortunately, right? So we can learn an awful lot, everybody, by seeing where our leadership resides over any given window, okay? All right, so let me see what I've got here in terms of some questions. I got a survey opportunity. Would love to hear from all of you in the survey. If you have a chance to complete that, it takes like 60 to 90 seconds. You can click that link right now and it'll just open in a browser window for you. And then you can get to it post-show. I would absolutely appreciate your feedback. I love reading it, and I try to bring comments that you bring to me. I try to bring those to your next events here, your next segments. So I'm happy to hear from you all there. Mighty Mouse, may I ask why? If there's inflation fear out there, gold is tanking as much as the S&P 500. Well, I'll admit I hadn't noticed that. Let's take a look and see if there's a relationship there. So commonly with fear stoke or some concerns about it, we see that you get gold performing well, and you notice that gold recently made new highs. I'm not sure of the conversation around the movement in gold at this point today, but when I look at it here, I would say from a trend standpoint, traders would probably tell you, well, it's gotten a little overextended, might be in the midst of a pullback. This is not necessarily a breakdown move, as you can see from the look of things, everybody. You've got an uptrend line in place, 50-day moving average in place. Shorter term moving average might be driving the current trend. So if we looked at more likely the 20-day moving average, which I'll replace in there, we're falling through it today. So that may be a little bit significant. So that could be some profit taking. Now, let's bring this back to that slide we were looking at a bit ago. Remember, I mentioned when you go through windows of uptrends, so we're going to use an uptrend as an example. This could happen in downtrends as well. Uptrend situation right through here. When we broke down, I want to point out, I drew this line in here. I'm going to remove it. This breakdown move in the price of the metal did not find support at a moving average. It fell through the moving average and had to find support at a horizontal ledge. And that happens to be coincident with what were prior highs, thus prior resistance becoming new support. So if I were to, we're going to go back and just revisit. Remember, I love bringing you all imagery in the wild, as I like to call it, in the real charts, real world analysis that can be relevant to our topic here. Well, resistance once broken becomes support. Here we broke resistance to the upside. We call them a breakout. And then we spent the next 4 to 5 sessions just kind of meandering. Now you'll notice that at one point our low was pretty darn close to the green line in here, right? So that looks like an appropriate support test. And then it went higher from there. Okay, it started working against that 20-day simple moving average if I start bringing in new days. You see how that went? So what was support became, what was resistance then became a potential new support. The hope, of course, is that you witness it not going down at all and doesn't have to come back into play at any point, but anything that was a level of prior resistance can now be considered a potential layer for new horizontal support. So I'm going to take this line, which was, of course, at the time it made the first high right here. That was the all-time high, and that became a new point for resistance. And then check this out, everybody. As we got right back into that same line right here, this day we tried to get to it, couldn't. Here we have a day where the market just said, well, we can't go anywhere. We call that one single day. That looks like a spinning top, potentially a doji, where our open price and our closing price are essentially right on top of one another. But that happened at a point of potential resistance, which gave buyers a reason for the pause. And then the very next day, it took off and started rallying again, and we pushed all the way up to 29.74. Again, I'm just looking at this from the standpoint of price action. Ignore the symbol. The truth is the symbol doesn't matter, right? Because the trend analysis is the same. In fact, what I have found, and I think some traders out there may have found the same thing, eliminate the symbol from your screen. Try not to allow the symbol on the screen to dictate or bias your viewpoint at all. That can be hard to do, right? Because if you believe in the company or you want to own the company, no amount of price action is going to dissuade you from that if underlying everything, you just want to be an owner. You're going to find yourself falling into this bias conundrum, okay? And I want to encourage you to try and avoid that as best you can. Now today, in our final 15 minutes, what I want to spend the time doing is utilizing everything we've kind of talked about here as it relates to the S&P 500, a potential move lower in the S&P 500, and a potential example for leadership in the market that differs from what we've seen previously. So let's go to our scan tool and let us build a very standard scan that is going to locate opportunities in consumer staples or healthcare, which are the two, or you know what, let's not do healthcare. Let's do consumer staples or financials today, because we've got, well, hang on a second, I got ahead of myself. Financials are up, they're positive, but that's not a great looking candle. And we've just found a pretty good amount of resistance. I want to see if we've got better leadership here. So healthcare, unfortunately, is pulling back. Well, we're going to have to look at, I guess, let's look at real estate here real quick. Well, you've got an improving chart here, right? Improving in the sense that we made these big moves to the downside and have really seen a rally as yields have kind of come back in line a little bit. And this makes sense because if you think about what the real estate sector as it relates to the S&P 500 is, this spider real estate group, this is not real estate in the sense of buyers, home buyers, builders, excuse me. They are the REITs, the real estate investment trusts designed to pay dividend or interest income, commonly dividend income on a monthly, quarterly, annual basis, something like that. And so if the market is getting a little bit less confident or more risk averse, well, then traders might find themselves saying things like, well, I'd rather just lean into something that's going to give me a dividend every month or every quarter and give me some opportunity for more upside, meaning that the trend in this space is now up in a specific window here, right? This particular window of time. So the investor might lean a little more confidently into these groups that do better in this type of cycle of the market, okay? So maybe we look at just a couple of those spaces. Before we do that in the scan, I mentioned we talked briefly about Market Watch and using the quotes. You can also do this, everybody, if you're more visually a learner and you pay attention daily by looking at something like the heat map. You can always go at it this way. I think this does an excellent job of showing you where the opportunity is. For example, let's go into that staples space. I'm going to click on it. There you've got all of the staples, right? So you'll notice your sub-industries here, your industry groups. There's your distribution and retail, incorporating Walmart and Costco, Kroger and Cisco and Target, Walgreens, etc. Tobacco over here, very limited in scope in terms of its industry group any longer. Food products quite a bit bigger. You can always, though, open it up, everybody, and get those same groups. Go to beverages. You can see the beverages groups within. Again, this is all within exclusively the S&P 500. Okay, bit different if you went and looked at it from the standpoint of the Russell 2000 and you wanted to go into consumer staples there. And the reason, let's just do this real quickly before we talk about that scan one more time. I mean, again, the difference here, the S&P 500, your 501 largest companies in the US market versus your Russell 2000, the small cap companies, right? The 2000 small caps, and they're also making a similar breakdown move. Now, one thing that some traders would take from this is, hey, these groups are moving in concert with one another. We need to be paying close attention to that. You'd be accurate in suggesting as much. It is not terrible that the markets move together. It is not great when they move together and we're getting them selling off as we are right now. So if we were looking for opportunity, the hardest thing to do today is to say that I would be loving to own S&P 500 investments as we fall through areas of support. But if you were looking for S&P 500 investments, you might, as an example only, lean into staples. You might lean into real estate because they've been the ones providing that ongoing leadership over the prior few months. And today, a difficult day, are providing leadership as well. So we can go into the scan tool and we can have it set this pretty basic criteria. So let's do some basic stock stuff like last trade or closing value here, just so we can define a price range. So let's just say we want stocks that don't exceed $200 a share, just to kind of keep it limited in nature. 10 to 200, still a big group of stock. Beyond that, we want perhaps to be considerate of trends, right? We've talked all day thus far about trends. So one of the things you might want to witness is seeing the current price action is above one of those shorter term moving averages. Commonly, we talk about them being over the longer term moving averages, like a 200-day moving average, for example. But if we are looking for leadership, well, then we should be finding stocks above a faster or speedier moving average, like a 20-day, for example. And in that case, I might want to incorporate a study filter. So I'm going to go to add study, add filter, click study. That's going to give me by default my ADX crossover because that's the first one in the alphabetical list. I'll click that pencil and it gives me my pop-up window, and I'll hit delete here so that I am fresh starting from scratch. I'm going to add a condition. And here I'm going to want to incorporate the last trade or a close that is above the 20-day simple moving average. So again, let me just highlight that once more. Add condition, select the condition. I'm choosing a price to start me out. The closing trade, or on a day-to-day basis, intraday during market hours, that close is going to be the last trade, okay, or the on the chart basically. And I want it to also be greater than a 20-day simple moving average. That's for our example, one of the faster moving averages. You can absolutely go faster if you want. Here's where things get a little tricky. I'm going to designate study, and now I'm going to look for simple moving averages right there at the top. Now, don't forget that simple is only an example. If you said, you know what, Kevin, I'd rather work with an exponential, no problem. Let's do a moving average exponential. And let's just say that it's the 20-period exponential moving average right there. So that's where, excuse me, I'm making an adjustment. The defaults is to 9 periods. I'm making it 20. I'll hit save. And then, okay. Now that is very basic, right? Price between 10 and 200. The stock is above its 20-day moving average. Now we're going to scan in the public group, S&P 500, and intersect specifically with one of our industry groups. So we're going to intersect it with consumer staples. Now here, remember that you don't have to select the entirety of consumer staples. That's the whole sector. Maybe you've already done the work and you know that you want food products exclusively, or you want the distribution in retail exclusively. I'm just reminding you, you don't have to keep it generic as I'm doing here. So we're going to select all consumer staples. Wiley, thank you. First for the encouragement for a thumbs up, but secondarily for the reminder that studies will, like this in the scan tool, are not going to carry easily within the paper money version of Thinkorswim Desktop versus the live version. So you may very well want to get working in the live version of the Thinkorswim Desktop here, everybody, okay, when building your scan. So again, thank you, Wiley, for bringing that up. I needed to be reminded, and I needed to bring it up to all of you as well. So we are looking in the S&P 500 consumer staple stocks specifically with a range of $10 to $200 a share that are trading above their 20-day moving average. Let's see what we find. Well, we've got a pretty healthy list. So this is cool because check this out. If I already know that it's going to be a lot smaller, but if we went in and just tried to do this with technology in the S&P 500, I wonder if it's a much smaller list. Well, it is. Look at that. You shouldn't be shocked by that, right? We should know that instinctively that should be the case. We will absolutely get fewer tech stocks right now above the 20-day moving average because tech has been struggling. Tech has not been providing leadership. So going back into staples, okay, hit scan. We've got a pretty healthy list, 28 companies. So a couple of things we can do, right? You can take this single list and make it a watch list right from here, from your action menu right here. Or my preference is to give this scan a name. So we save the scan query, which brings me a new pop-up window. So let's do this. Let's call it Kev's Thursday. I'll hit save on the scan. And then if I want, this is my favorite, one of my absolute favorite tricks, is to just create a new watch list using your personal stuff. I just made Kevin's Thursday, right? So here it is, Kev's Thursday. And you see that little bullseye, pink bullseye icon? How cool is this? I click that. That list is the list we just saw. But the best part is I don't need to do anything with that list. Later today, tomorrow, next Monday I come in, that list could be very different. These are the symbols that are applied to this chart or this watch list exclusively based on this criteria in the scan. Okay, so as one of those stocks is no longer above its 20-day, that's going to fall off. And if a staple stock that's not on the list captures its 20-day, it's going to get added to that automatic dynamic list. You don't even need to do anything with it. So save that scan, make it available to you, change your detail here, make it purple, in my case purple, so that it matches up with my chart. And now I can start going through what I call chart triage. And I like to do that by just clicking the first one, and then I use my arrows in my keyboard, and I just arrow down, look through the next one, look through the next one. And I'm looking for something that catches my eye, right? You're not focusing on the specifics of the chart. What do we know about this list? We should be finding uptrending stocks trading above a 20-day moving average. I didn't give you more criteria. We absolutely could have, right? We could have incorporated shorter term details, like a 20-day moving average being above a 50-day. We wouldn't have gotten ConAgra then, would we? Because the orange 20-day is below the purple 50. That wouldn't have happened, right? So we can learn how to refine our criteria a little bit. Keep on moving down the list. What else do we have? See, here's one that's maybe looks a little different. Is it at all-time highs? Not quite, but it does look a little different than the other ones we've seen thus far. And it looks like you may have a bit of a trend shift here, potentially. Broken downtrend line that got tested today, possibly. Okay? So moving through, just giving us something to monitor and consider. And then if we find something that jumps off the screen and says, well, hey, maybe there's an opportunity there, well, then we can consider building a possible trade. Now, see, there's one that stands out right now. Why? Because and this might be easy for myself because I've been watching this, not this stock, but rather these charts. My colors are valid. My colors stand out to me. I know we're above the blue 200-day moving average. That might be a significant short-term development, right? Some traders would look at that and say, well, you've been above it for more than a week and a half now. That looks like a potential new uptrend in place. You've got a crossover, short-term moving average crossing an intermediate term to the upside. That's a bullish indication in the short run. We'll see if that works out. That might make it to a watch list, but it's an improving chart. And you just keep working our way through. I keep looking for something that looks a little more like the standard of the Staples group, and it does seem like Coca-Cola might be the one that's in the midst of things there, right? Closer to the highs, has made a good run off of the support line back here. Let's go back and talk briefly about that. Remember what once was resistance can then become support? Let's add a little more time to my chart here. Let's go and get 2 years, and we'll see how that looked. Ah, yes. So let's just zoom in to right here when we were trying to say, hey, can we get through that 6140? Can we get through it? And we kept running to it, breaking down. Run to it, broke down, run to it, broke down. Here we have that, and we could see on the chart, we know we go through it, right? But it was resistance until then. And then once we're through it on a day or two, maybe 3, some traders want to see a couple of consecutive days above it. Well, as you can see, it provided that support along the way, everybody. So there was a pretty standard opportunity of basic support, resistance becoming support here. We broke all the way to the upside, broke down, tested it, and held it, moved off of it again. So what I love about this one as an example only is, of course, we banged our heads on it, we got through it, and then we made an amazing rally from 61 and change up to 73 for almost 20% rally. And then we completely round tripped it all the way back to our breakout level. I'll tell you what, people, that happens all the time in the stock market. You may not expect it. You might be thinking, oh my goodness, that Coca-Cola, what a wonderful trend. Just look at how strong it is. Look at how wonderful it's working against that 20-day until suddenly it's not. And if you're a trader, this is where you start talking to yourself about, man, I need to be smarter. I need to be willing to be a seller as these stocks make new highs, reduce my position size, recognize that the trend changes. When it changes, I need to be moving out of portions of my position, mitigating my risk by reducing the exposure to the position itself. And I hope that today's conversation has done a nice job of just kind of, giving you the framework of thinking about the broad market. What is the broad market doing? All right, now I got that laid out. What about the groups? What sectors are giving me leadership? Further, what industry groups are giving us leadership? Where, if I want to be bullish, where do I have to look right now? Okay, don't make this harder than it needs to be. It can be as simple as going with what's working and ignoring what's not. Okay, so Hopefully we covered that in a pretty good detail today. I want to thank you all for being here, for joining me. We did have that survey reminder in the chat, so please click that link and provide for me a couple of statements about how you felt today's conversation went, what you're looking for from this particular discussion, this session specifically as well. Love to hear from you all. So thank you for taking the time to do that. Follow Mike and me on X, Mike Fairborn CS, Kevin Horner CS, and hit that thumbs up button down below for me. We're going to get this one reviewed, edited, and available in the archive here in the next 12 hours or so. So thank you so much for being here, everybody. And don't hesitate to reach out there on X. If you have questions additionally, I'd be happy to answer those for you there on X. So thanks for being here. Have a fantastic Thursday, everybody. I look forward to seeing you all again real soon.